I'm delighted to be joined, or to join Tom on stage. It's great to see you again, Tom. This is how small the world is. Tom and I were sitting next to each other by complete accident last week at a lunch in Boston. So that was a perfect preamble for today. I know that the crowd is very interested to hear what you have to say on current markets and how to approach them. And also, as Mo alluded, on the unique path that has brought you to inform your perspective on markets and brought you to where you are today. Super briefly, I can say that in my travels, I spend a lot of time globally speaking with a lot of different investors, individuals and institutions alike, and everybody is kind of expressing the same concerns, and we're going to touch on these topics with Tom and with Cliff. These are topics like, how do you position a portfolio in a lower for longer interest rate environment, and how do you extract value out of current equity markets? So we're going to touch on all these things. Maybe the best thing to do would be to kick it off with a little bit of background from Tom. Tom started investing straight out of college, and it would be great to hear from you how you embarked upon this path to begin.
Okay, thanks. Yeah, so actually I bought my first stock when I was 10 years old with paper out money, and bought two firms close to my hometown, one called Wheeling Pittsburgh Steel, and the other one called McCrory. It was a 5 and dime, both of which went bankrupt. Fortunately, I got out of Wheeling Pittsburgh Steel before it went bankrupt, but I ended up collecting coupons on a bond that I got in a reorg from McCrory when I was, 10, 12, 14 years old. So I'm sort of a rude introduction to the capital markets. I really got involved in investing because my father was a product of the Depression, failed 3rd grade because he had to work on the farm. And somehow, and he had this terrible fear of being poor again. And somehow he transmitted that fear to me. And so from the time I was really pretty young, I felt the need to be financially independent. And so when I got out of college, I had this 30-year financial plan laid out, saved 2/3 of my income. I lived in ramshackle places for a long time. But what that allowed was I started investing very early, and it's, learning is a repetitive process, so I got to try things in the market. I did that over and over and over again until I was able to build up my capital and leave. So I'm very much a self-taught person with, and learned with no confines, and so I've sort of developed a system to work when you don't have anybody else telling you what to do.
It's great that you laid out a plan, and it's a very scientific approach right out of the gate, which corresponded well with your career move subsequently. What were some of the more memorable or difficult lessons that you learned along that path as you got started and as you started to season that investment approach?
Yeah, so I think there are two types of people that make really good investors. There's the adrenaline junkie, which I am, and then there's the other extreme of the personality spectrum is the person that just hates losing money so much they're incredibly cautious. And both those personalities, to be really successful, need to move to the middle. And in the Volcker period, I made a huge bet on interest rates dropping. And unfortunately, they went up before they dropped, and I lost about 70% of my net worth in a week because I was really levered to these things. So very painful lesson on leverage. I do note of it. I wish I could say I never made that mistake again, but you do make these mistakes 2 or 3 times. But there's just a lot of, reality, and I always say the market's a much better teacher than your mother or your dad because it just takes your money and you can cry and kick and scream. And it doesn't care.
Very good. Well, clearly you've had a lot of massive wins, given your track record, offset by a couple of painful points. Your first career was actually in the chemical industry, which is a bit of an unorthodox path. What was it about that experience that you were able to use to inform your path going forward in investing?
Yeah, so since I worked as an operating person for 17 years in a company called Roman Haas, I had to develop business plans and execute on the business plans. So I always reflect whenever I'm with some analysts and they're talking about, well, this guy doesn't know how to run a business or execute a business plan. I think, well, how do you guys know you've never executed on a business plan? So I think just having to execute in a business setting is really important. The other thing is I worked in a lot of different places. I worked in Mexico for 8 years. I lived through the Maxi devaluation when the peso went from 25 to 250 in a matter of a month. And just trying to deal with all the things that go on when you live in a Maxi devaluation. Then I lived in London when they were making the European Union that we have today, and trying to price, before you had pricing all in different countries, trying to uniform pricing. And just, investing is really just connecting dots. And I think the more, if you're paying attention, you can turn almost any experience into a learning experience to improve your investment skills. And running significant organizations really helped me do that.
That's terrific. When we were at the Super Forecasters portion of today, it just occurs to me that you're highlighting a lot of the points that they highlighted in terms of what you need, the composition required to be a super forecaster. So it probably bodes very well for you. Turning to
that book, I have read the book, and it is essentially what we try to do all the time. Excellent. We try to boil our investment ideas into 2 or 3 key reasons why we want to own or be short something, and then we constantly monitor against those 3 key issues to see if we're right on our thesis or wrong on our thesis. And it's all about really seeing with clarity, and to see with clarity, you really have to have an open mind. And one of the sayings I like the most is, certainty means a closed mind.
That's terrific. Yeah, when you think about the points that they expressed, the need to have humility, introspection, intellectual horsepower, at times high conviction, avoidance of groupthink, all these things really seem to feed into your history and your construct. And I'm paraphrasing you, but your self-awareness. So that's a great segue for me to ask, what were the tendencies? You started this conversation by saying you kind of want to, I believe, you want to see people that are half adrenaline junkie and half hate to lose, although you seem extraordinarily balanced to say such a thing. What are the tendencies that you saw in yourself that you knew you had to either accentuate or manage a little bit as an investor when you're dealing with a multivariate environment and all kinds of, a million ideas and funneling down to a smaller universe?
Yeah, so if you're a person like I am that, most of us like activity, right? We have a hard time, they say the hardest thing is to do nothing. Well, it's impossible for me to do nothing. And I remember back the first time I started short selling actually was in the run-up to the Black Friday, sort of a year out from that, so this was like 85, I guess. And stocks had gotten really expensive, and I knew I wouldn't sell everything. My personality is one of engagement. I want to be engaged in doing something, being active. And for me, just to sit on the sidelines is very, very difficult. So what I said, well, I'm going to start short selling because then I can stay totally engaged and still protect myself to a down market. And so that's one of the personality flaws that I have. The other one is, since I am a little bit of an adrenaline junkie and I get excited easily, I love opportunity. I mean, I get so enthusiastic about the next great opportunity, is I just had to put in place ways to slow myself down. So we have this, we allocate 2% of our capital a week, so I'm not out there, putting a 10% or a 20% bet on really quickly. Because what I discovered really early is when I got really excited about something, I should be really careful, because those are the times I would make my biggest mistakes, because you do them big and you're excited, and so you're sort of like getting married, It's your point of maximum excitement is that day, but anyway.
Hopefully this is
Same
closed.
same thing's true about oil wells, by the way. It's the best oil well the day before you turn it on.
Hopefully this is closed to media.
Yeah.
You touched earlier on an interesting point, that you reallocate roughly 2% of capital, more or less, systematically. Is it every week, every month?
Every week.
Every week.
Right.
How did you come across, like throttling that takes an awful lot of discipline. How did you come across that as the roughly correct number? Or is there variation? Naturally, there must be sometimes is there much variation when you run into a difficult market environment, or when you're approaching what could be a highly volatile market, as we're seeing maybe in the US in the next 10 days or so?
Yeah, so the great thing about having a system is it frees you up to act when you really need to do something outside your system, because you're not having to think and question your asset allocation all the time. So 90% of the time we do trade roughly 2% a week, and we trade in the direction that if we're trying to get more short, we add more short. If we're trying to get more long. And by the way, we always do this counter to the market. So if the market's going down, we're buying. If the market's going up, we're selling. And we do that very, very consistently. But there are times when, and there aren't many, but the last one was in the oil crisis. We had gotten about 20% net long oil and gas. This was probably 2011, 2012. We got very concerned about the gas market based on what we saw happening in the Marcellus and the Montney. I mean, these monster wells people were drilling. We said, man, the gas market's dead. We're getting out of our gas stocks. And then we had the same apprehension about the oil market, but really didn't act in time until we saw prices really start to drop in 14. And then I came in one day and sold all our oil stocks, and thank God I did. And we went from, at that point, we'd gotten down to about 10 or 11 net long, and we went to about 2 or 3% net short. Should have been 10 or 20 net short. But that's an example. But that was caused by cumulative conviction over a long period of time of watching the oil markets, watching the behavior. I remember I went to the Intercom conference August of 2014, and I would say 90% of the companies there were spending 2 to 3x their cash flow, which in itself should tell you what to do, right? And then you start seeing prices fall and inventories building, and at some point you just say, I'm out of here.
To follow up on that point, are investors these days are they a bit more emotional at times because they're being bombarded by a 24-hour news cycle, and we seem to have big crises that erupt regularly, and then for some reason the half-life of these crises seems to be really truncated. Like something really big and bombastic seems to happen every month, every 2 months, and yet it seems to disappear in the ether afterwards. And it seems to feed what can be really like an already nervous or skittish investment environment. Is it important to step back and take a longer-term perspective against that, or has it been the same way for the last 10, 20, 30, 40 years? Have things changed a bit?
Yeah, so I would say there's two markets. There's the Colosseum and then there's the Roman Senate. And 80% of the money gets managed in the Colosseum. And in the Colosseum, you just want to live till tomorrow. You kick dirt in the face of the other guy, you fight the lions and the tigers. And you just want to get by the day. And then 20% of the money is managed more with a longer term view and a consistent strategy. And we hope to be in that second category, although you really have to be aware of what's going on in the Coliseum. But I would say, there's always been noise. I think media makes us more sensitive, so we feel like things are a lot worse. But World War II wasn't a lot of fun. Neither was World War I. I mean, the bubonic plague. I mean, life was, as I say now that I'm 65, getting old isn't for sissies. Living is tough. I won't say it. Bad things happen, and they happen all the time. And to think that if anything, it probably happens less than it does. And I'll give you an example, because I think some of this stuff, for me, gets really personal. So when I grew up, little town, 4,000 people, when I was 8 years old, I wouldn't even tell my mom was leaving most of the time. She just expected me to leave. I'd get on my bike at 8 or 9 in the morning, and I'd go fishing. And the only rule we had at my home was you had to do your chores and be back home at 6:15 for dinner. Now, if you let your 8-year-old kid today leave and not show up for 10 or 12 hours, you'd get your ass thrown in jail. At least you would in the U.S. I mean, here it might be. And, you know, that would have robbed me of a tremendous amount of development of my independence and all that kind of thing. And so I think this hypersensitivity we have to events is leading us to disappear up our, and an example I'll give you just in, you know, I wish she was still here, but we had a meeting yesterday in my fund, and the meeting was all about the recent event. What's the guy? Cooperman. So Cooperman does some stupid stuff. He gets on the phone, talks to the management team. It looks to me like, you know, I'm not using the super forecasting rules here, right? I'm not being very analytical, but it looks, you know, you buy huge quantities out of the money calls on a deal, you know, on a company that goes through a deal that you just talk to the management team, it's a little bit. So the SEC gets this, and it's sort of like, if you ever have a chance when you're in New York, go to the New York Yankees restaurant and take a look at Babe Ruth's baseball contract. One page, Babe Ruth's baseball contract. And so what's happening to us is, you know, 20 years ago when you bought a house, it was 2 pages. Now you buy a house in the U.S., it's 200 pages. Nobody reads it. And the same thing is happening in our regulatory environment for hedge funds. So based on the Cooperman accident, now what my internal compliance people are saying, you know what, Tom, the SEC is now going to demand that we demonstrate that we are making sure that our people don't get inside information when they talk to management teams. And what they're recommending is we take minutes on every management contact we have. Now, I talk to management teams 3 times a day, 4 times a day. I mean, the burden is just amazing. But the hypersensitivity, the hey, no risks here, the legalistic approach, this is more true in the U.S. than anywhere else in the world, is just making it a miserable place to do work. And I think ultimately is going to have, I think that is, the regulation we're going through is the #1 problem with productivity growth.
Fascinating. I'm taking a couple points from this. Number one, the crisis that you're in always feels like it's the biggest crisis, but if you pick up a history book, we've been through far worse.
Yeah.
2, perspective certainly brings a lot to the table and can probably illustrate or illuminate some of the biggest opportunities, some of your best trades. Can you talk briefly about the, you know, how it felt? We're talking about things systematically, scientifically, and bringing a personal touch to this as well. How did you feel through the global financial crisis, and how did you manage a large group, a complex organization, a multivariate environment, all kinds of information coming in, and a terrific lack of information as well? And how did you also deal with your investor base throughout that period?
Yeah, so the biggest and best opportunities come when you're choking to death. And you've been beaten up so badly, you almost can't stand it anymore. And some of these things are, sometimes they're real obvious and sometimes they're not. 08, 09 was probably it was the worst time in my experience in the business. And the reason it was the pain inflicted was so great that major institutions were afraid they were going to go out of business. And I had clients that were worried they're going to have to go out and get a job again. You know, these people hadn't worked for 20 years, you know, so you lose all your money, you got to go find a job. And so we managed money for one of the biggest financial institutions in the U.S. It's a household name, I won't use it. But they came to me in December of 08 and they said, you know, Tom, when volatility goes up, we want you to reduce your net exposure. I said, and I'm a total absolute return. And you know, I'm trying to I'm looking at this, I'm saying this is the biggest, fast opportunity I've seen for a long time, even though I'm choking to death. And I said, volatility almost always goes up around turns in the market. When you get to market extremes, you get higher volatility. So if you focus on volatility and try to minimize volatility, you're going to get out of the market right when you shouldn't every time, because you're going to collapse under the mantra of lowering volatility. So this client says, you got to do that. And we said, well, you got to take your money. So they did. They happily took their money. That was December of '08. And then my largest client called me, I think it was the second week in February, and he said to me something like, Tom, you're losing a lot of money. And I said, oh, no shit, Fred, I hadn't noticed. I'm down 50%. And just one day before I had this nightmare, so I got divorced right at the peak in '08. And my deal with my ex-wife was, don't screw up my businesses, I'll pay you X dollars per year for the rest of your life. And I wake up in February, right before this call, with a chill and a thought, shit, I'm going to be a slave to my ex-wife. I'm not going to be able to make these payments. And so I said, no shit, Fred. He says, well, what are you doing about it? I said, well, I'm buying stocks. He said, what do you mean you're buying stocks? I said, sure. He says, don't you think things are bad? I said, of course they're bad, Fred. If they weren't bad, stocks wouldn't be this cheap. Well, don't you think they can go down more? I said, well, of course they can go down more. I said, well, then why are you buying stocks? I said, Fred, because they're cheap. And he said to me, he says, Tom, hope is not a business plan. I don't care what you do, don't lose any more of my money. And he hangs up on me, my biggest client. 6 months later, the market turns around, we get waiting that long, we come out, we have an up 50 or 60 year, and he invites me to his conference to be one of his speakers. So
That's fantastic.
Classic, right?
Well done.
Yeah.
So that also begs the question, we're coming out of, or we're in, what some could present as an artificially low volatility environment. Whether that's a function of central bank intervention, or that's a function of groupthink, or people chasing returns, people chasing yield. There's been this sort of asymptotic trip from here to here in terms of rates, everything else. The funny thing is, when I look back on this, having this conversation, in the 1970s, some of these factors were here as well. We had central bank intervention, we had it was the precursor to higher inflation. We had low growth. We had people hunting around for sources of return that weren't necessarily there. Looking forward, do you see us getting into a period of heightened volatility? Or do you think we're going to feel like this? Is it going to be lower for longer still? And the footnote to that question is, either way, do you feel like it's going to be a great environment for your strategy personally to make money regardless?
Yeah, so nobody knows what's going to happen, and I think that's part of the super forecasting book is, one of the most important things to be a good investor, I think, is humility and to sort of recognize when you just don't know, right? And what I'd say about volatility is it's been pretty low, so it's probably going to get higher. How is it going to get higher? I have no clue, but it probably will. And I will give you one scenario of how I think it'll happen, and also the distortion that I think this is causing currently in the market. And these things become self-reinforcing. How did the tech bubble in 1999 ever happen? How did I do a screen, I call it my Evel Knievel screen, which is 5 times book value and losing money. And I'm just looking for companies that are going to try to jump the Grand Canyon but don't quite make it. Those are great shorts. And at the end of '99, I got my ass kicked on the short side, and I'm trying to figure out why. And I run my Evel Knievel screen, and there's usually 50, 60 companies over 5 times book value and losing money. At this time, there were 240 companies over, I think it was 50 times book value. And half of those had doubled in the last 3 months. Doubled. So you have the greatest short opportunity of a lifetime, and you can't execute. I mean, you try to execute on that and you get your head ripped off, right? So the thing that's the parallel now is, and it's part of what's caused so much misery in the long-short space is, and I call it the safety trade. You have a ton of capital that has migrated into safe assets, right? And they're safe till they're not safe, right? And those assets are food companies, utilities, anything that is perceived that has REITs, anything that has what's perceived as a safe dividend, a safe payout. And I can tell you, the conference we were at last week, the pension funds are desperate for return. And most institutional investors are desperate for return because it's just not there. It hasn't been there. And they have mandates to fulfill. They got pensions to pay, and they're scared to death they're not going to be able to pay them. So you've got this, and these things happen partly because of opportunity, partly because of fear. So you've got both opportunity and fear driving people into the safety trade, right? The flip side of that is you've got companies that are considered more variable, more economically sensitive that are super cheap. True Blue, company that provides blue-collar workers in the U.S. on a temporary basis, very economically sensitive, 8 or 9 times earnings. I mean, I can go through tons of stocks that are 5 to 12 times earnings, while I also say I go through all the earnings reports in the U.S. pretty much every day, and the number of companies with -4 to +4 revenue growth trading at 30 times earnings, I've never seen as many of those. But they're considered, it's the Kraft Foods, it's these things, and so we're trying like hell to figure out how we can best, so the first thing I'd say is if you're in that trade, be careful, because it's probably about to unwind at some point. And we're busily trying to figure out how to take advantage of that by being short. And we're going to try to short the companies that we think that currently are considered safe, that all of a sudden are going to become unsafe. And one area I'll point to is like some of the insurers are trading at 20 to 30 times earnings. And we think insurance rates are finally getting really weak. And so we think insurance earnings are going to start to roll over. And all of a sudden, that safe haven will change. Maybe not across the board, but we're looking for those kinds of things.
So watch out for crowded trades, because there's less liquidity arguably in this market than there's been in a long time, and everybody leaves at the same time.
Yeah.
Watch out for the academically cyclical trades, because we're not necessarily in a cyclical environment. We could be in a period of sectoral stagnation. We could be in a low growth environment for a long time.
Yeah, and
be agile.
Yeah, and the positive view, there is a positive way the safety trade unwinds, and that is, hey, maybe the world's getting better. The economy's getting better, rates are going to go up, and people are going to gravitate away from the safe stocks to more risk-seeking stocks because things are better. That's what I'm hoping.
Tom, I could talk to you for 2 more hours, but I'm going to get the hook.
Yeah, that's good.
They'll ask you to leave politely, but they'll give me the hook. Thank you so much. Please, a round of applause for Tom.
Yeah,
Great insight.